Very good evening to all of you. On behalf of Auditing and Assurance Standards Board of Institute of Chartered Accountants of India, I welcome you all in today's webinar on CARO 2020 Interplay with Schedule 3. As we all are aware, the topic is very important, and in order to tackle this, we are having with us CA Amit Hundia ji. So, on behalf of AASP of ICI, I extend my warm welcome to you, sir, on this AASP platform. Welcome to you, CA Amit Hundia ji. Namaste. We are having with us CA Shrishti Kansal ji, today's moderator. I also welcome Shrishti Kansalji on behalf of AASP of ICI.
Thank you, sir.
Honorable Chairman Sir and Vice Chairman Sir both are stuck up in another meeting. So I take this liberty to start today's webinar. So I request Madam Shrishti Kansalji to please start the proceedings of today's webinar. Over to you, Shrishti Madam, please.
Thank you, sir. Good afternoon, everyone. I welcome you for today's webinar on auditing aspects in CARO 2020 and its interplay with Schedule 3. My name is Shrishti Kansal, and I'll be your moderator for this session. I currently work as a consultant in a business risk advisory, and where I specialize in helping organizations identify and manage their business risk effectively. I'm excited to be here today and to guide this important discussion featuring our esteemed speaker who bring a wealth of knowledge on auditing aspects in CARO 2020 and its interplay with Schedule 3. And Mr. C.A. Hundia, he's just not a chartered accountant, he's also a qualified company secretary, a law graduate, and a DISA holder. He possessed rich working experience of more than 2 decades in the field of assurance and advisory services. At present, he's a partner in Singhi and Company, a chartered accountant firm, which is a member company of the Murray Global Group. Previously, he was a partner with BDO Haribhakti and has spent more than a decade with them. He has worked on various assignments as a technical reviewer for Quality Review Board and technical reviewer for Financial Reporting Review Board, formerly by the ICAI. He possesses international exposure as well as and worked on secondment in New York and other places in the US. On sharing on the knowledge front, he has been a speaker of the Auditing and Assurance Standard Board of India and various other forums of ICAI. So now, just to flow some ground rule rules, this session will approximately last for 120 minutes. And I request everyone to keep your microphones on mute while our speaker say something. And feel free to use the chat box for questions, and we'll definitely address them during the Q&A session. Now, without further ado, I'll dive into the session. I'd like to invite CA Amit Hundia, sir, to start with the topic. Over to you, sir.
Thank you, Shrishti. Once again, thank you to the entire ASP and the members of ASP, NLG, and everyone who had scheduled this particular session, which is quite important. As we all know, now the year end is nearby, and most of the audit teams would have started working on the interim audits, and many listed companies will get closed by mid of April or end of April or so. So it's better that people are getting refreshed with the requirements of the CARO 2020. So this is one of the important topic in the today's period. I mean, when I say today's period, because it is nearby to the budget session, people are now more inclined to hear the amendments in the budget. But in addition to that, this is also one of the important session. So I'll try my best to share whatever knowledge I have with everyone. And then we can have the Q&A session at the end of the entire duration. So I'll just share my screen. I hope my screen is visible.
Yes, sir.
Yeah. So once again, very good afternoon to everyone, to all the participants. Today we are going to cover up auditing aspects in CARO 2020 and its interplay with Schedule 3. These are the contents which we are going to cover in our today's session. So about the applicability of CARO 2020, clause-wise comparison, key aspects, Schedule 3 reference in the guidance note, and with regard to FRRB, QRB, or NAFRA, some of the key contents which are required to be touched upon. A very brief slider to that part. If we move forward, Ministry of Company Affairs had issued the CARO 2020 on Feb 25th, 2020, and it came into existence, or it became applicable to all the audits from the financial year 21-22. This order is in suppression of the earlier order, which was issued earlier, CARO 2016. So it has replaced that particular order. There is no change in the applicability requirements as compared to CARO 2016, other than addition of a new requirement for reporting on the consolidated financial statement. So we will also touch upon that particular aspect. So the applicability criteria remains the same, which was there earlier in CARO 2016. And then CARO 2020 includes several new clauses, and many of the clauses have also been amended. So if we see on broader side, if we see CARO 2020 has much more depth and coverage as compared to CARO 2016. Many pointers or many reporting requirements have been added in CARO 2020. And this has been added by MCA after having due consultation with NAFRA. So the inputs have been considered with the recent regulatory developments or the recent updates which the regulator got from reviewing the files or the inspection or investigation of many of the other entities' financial statements. So on that basis, many pointers have been added by the regulator. And now I believe all the participants who have joined here will be well versed, because 3 years have gone after the issuance of CARO 2020. Still, there are some of the key areas which I would like to highlight, which I have observed that many a times the teams get missed to that particular pointer, and it will be very critical when we close the CARO 2020 reporting. So summary of changes as compared to CARO 2016. So this is a brief slide which depicts the number of clauses which have been added. So 7 clauses have been added, no changes in certain clauses, and 1 clause have been deleted with regard to managerial remuneration as compared to CARO 2016. The order has increased the reporting requirements. So what I said that it has increased the onus on the auditors. The auditors are required to look into more depth. They are supposed to evaluate each and every aspect of the questionnaire which has been issued by the regulator, and then are required to do the adequate reporting. So the coverage has been broadened to a very great extent, and those coverage has covered all the recent developments which had happened in the recent past with the various financial statements which are reviewed by the regulators. Further, the CARO 2020 also requires reasons to be stated for unfavorable or qualified answers. So where the answer to any of the question referred to in para 3 is unfavorable or qualified, the auditor's report should also state the basis for the same, like what we do in main audit report. If there is any qualification, we are supposed to give the basis for that. Brief reasoning, it should not be straight away only negative statement which you should give, like what are the rationales for that, and where the auditor is unable to express an opinion on a specified matter, the report should also indicate such fact together with the reasons therefore. So either we are giving any unfavorable view, or we are giving any kind of disclaimer kind of view on any of the CARO reporting clause, then we have to adequately give basis for the same. So if we see the applicability, what we discussed in our earlier slide, the applicability still remains the same. We will briefly touch upon the applicability and then we will move forward. So CARO 2020 is applicable to every company, including a foreign company, except the following. So if we see, CARO 2020 is applicable to every company, including a foreign company, except the following. So it is not applicable to a banking company, an insurance company, a company licensed to operate under Section 8, a one-person company, a small company, and a private limited company. Here there is a catch which one should be aware of. It is not only a private limited company, it is a private limited company which is not being a subsidiary or holding of a public company, and these parameters are fulfilled. So like paid up capital plus reserves and surplus not exceeding 1 crore as on the balance sheet date, or does not have borrowings from banks or financial institutions greater than 1 crore, at any point of time during the financial year or does not have total revenue greater than 10 crore during the financial year. So these are the parameters if are fulfilled simultaneously. These are not either or. These are required to be fulfilled simultaneously by a private company. If these are fulfilled, then CARO 2020 reporting requirement is not applicable. Otherwise, it will be applicable even to a private company. So, for better clarity of the entire audience, I have put a questionnaire here. So, I'll just touch upon on that question and then we'll try to see responses from the participants in the chat box. Please do attempt and then I'll share my response towards these questionnaires. So, in the financial year 24-25, Nasdaq Private Limited, which is a subsidiary of BSE Limited, the financial details of Nasdaq Private Limited are as follows. Its paid up capital and reserves are rupees 60 lakhs as on 31st March 2025. Presuming we are at the verge of 31st March 2025, the year has ended. So the paid up capital and reserves are rupees 60 lakhs. Its borrowings during the year from banks or financial institutions at any point of time during the year was not exceeding rupees 90 lakhs. And its total revenue is not exceeding rupees 5 crore during the financial year. So in these circumstances, whether reporting under CARO 2020 will be applicable to Nasdaq Private Limited. I'll request participants to please give their responses in the chat box. I'll take a pause for a minute.
I'll request the participants to please put in your answers in the chat box.
Shrishti, whether the participants who will be responding to the question, whether their responses will be visible in the chat box or it will not be visible, or are they able to access the chat box? I'm not sure. That's why I'm asking you.
I believe they are able to access it, sir.
Okay. Fine. I think I'll just respond to this question. So, on the apparent reading of this particular question and apparent reading of the situation, it appears that CARO 2020 will not be applicable to Nasdaq Private Limited. But friends, be cautious and understand the situation appropriately. Though Nasdaq Private Limited is a company which is a private limited company and has fulfilled all the parameters under which it can seek exemption from the reporting under CARO 2020 requirement, one should also be aware of that Nasdaq Private Limited is a subsidiary of BSE Limited, and BSE Limited is a unlisted public company, or maybe a listed public company, whatever the case may be, but it's a public company. So a private limited company, which is a subsidiary of a public company, will become a deemed public company. And once it becomes a deemed public company, automatically the provisions of CARO 2020 will get triggered to it and auditors are required to report on that. It cannot, a shelter cannot be taken that it's a private limited company and these criteria are not fulfilled, because its genesis of private limited company has been eliminated once it becomes subsidiary of a public company. And once it becomes a public company, whether any of the criteria or all the criteria are fulfilled or not does not make any difference. The provisions of CARO 2020 will be applicable and reporting is required to be done. Practically, I have observed and I have seen that many a times auditors miss out on this particular aspect. For example, there's a large listed company or a large unlisted public company which has various subsidiaries which are private limited. The auditors of private limited misses to report on CARO 2020 saying that these entities are private companies. So we should be cautious of this fact, and as an auditor we should take care, and accordingly we should report on CARO 2020 in such kind of situations. Second question. Nasdaq Private Limited is a holding company of BSE Limited, and all the parameters of the financial statement of Nasdaq Private Limited remains the same as stated in question 1 above. So here everything remains the same. Now in this situation, Nasdaq Private Limited is not a subsidiary of a unlisted public company or a listed public company. So by virtue of that, it is a private limited company only. It is not a public company. And all the three criteria which are prescribed for exemption under CARO 2020 are getting fulfilled by Nasdaq Private Limited. In this scenario, whether Caro 2020 will be applicable to it or not. So my answer to this will be yes, Caro 2020 will be applicable. There will not be any exemption, even though all the three criteria are fulfilled by Nasdaq Private Limited and it is not a subsidiary of a public company. However, it is holding of a public company. So if we see, just give me a minute. If we see the reporting requirement says not being a subsidiary or holding of a public company. So even though it's not a subsidiary of a public company, it's a holding of a public company. And pursuant to that, the reporting requirement of Caro 2020 will be there will be applicable to Nasdaq Private Limited. I hope this is clear to all the participants. By virtue of these questions, I believe you will be having a better clarity on the theoretical parameter. Then here, I have tried to make a comparison between Caro 2016 and Caro 2020. We will run through those clauses in brief and quickly. And while going through each of the clauses, we will also touch upon the key aspects wherever needed so that the things will be quite clear to the participants. So the first clause is with regard to maintenance of records of PP and intangible. There has been a slight modification. Fixed assets have been replaced with the phrase PP. And in addition to PP, records of intangible assets are also required to be maintained. This is a new reporting requirement. Then physical verification of PP, there is no change. And clause 3(1)(c) with regard to immovable property held in the name of the company, there has been a modification. And it has been specified that lease transactions are outside the scope of this clause. And format has been prescribed for reporting under this clause, which is tabulated herein. Here, friends, we should be cautious. So one of the key aspects here is while reporting on this clause is immovable property which are held as PP. If the immovable property is held as maybe, for example, inventory, then it is not required to be covered here for the purpose of reporting. So the auditor is not required to report in respect of other immovable properties not classified as PP. So there may be a possibility that immovable property is classified as inventory in case of real estate companies or investment properties in case of other companies. So under those scenarios, the reporting under this clause will not get triggered for such kind of immovable properties. So key aspects with regard to maintenance of records of PP and intangible assets. So here one of the relevant change which has been brought in by the guidance note on Caro 2020 issued by ICAI. Earlier in the entire database which were required to be maintained with regard to PP, the date of put to use was required to be specified. Now it has been replaced with date of available for use. So this is one of the key change which has been brought in by the guidance note. The reporting clause remains the same. And friends, please be aware that the guidance note on Caro 2020 issued by ICAI is quite comprehensive. It covers in details about the procedures which are required to be carried out by the auditors. It covers the kind of reporting requirement in various scenarios. So please go through it in entirety. And if you will see in public domain, you will be able to find two guidance note on Caro 2020. You have to be cautious and you have to use the Caro 2020 guidance note, which is revised in 2022. So you should not use the older one. You should use a new version, which is revised in 2022. The Caro remains the same. However, there have been certain alterations carried out by the ICAI in the guidance note for the benefits of its members. So this is one of the change which has been brought in with regard to the maintenance of records. Then reference is given for maintaining accounting records in electronic format using software that Audit cannot be disabled with, which is effective from April 23. So it has become effective from April 23. It has been observed that in case of large corporates, the records of PP are maintained in the software. So if the records are maintained in the software, then one has to see that the audit trail parameters or the features or the requirements of audit trail have been met with regard to that particular database. And if it is maintained in a physical form, the guidance note requires that the auditor, as a part of its work paper, should take the signed copy of the physical records and verify it and keep it as a part of its work paper. A new change which has been brought out here in reporting requirement for this particular clause is we have two sets of financial statement. One is under IGAAP and another one is under Ind AS. However, CARO 2020 is applicable to both in the similar situation. So even if a company who is preparing its financials on the basis of IGAAP, the same pointers for CARO 2020 will be there, and similar situation will be there for those companies who are following Ind AS. So here there will be a slight deviation. Those companies which are following Ind AS and they will have lease assets, they will have right of use assets as per Ind AS 116 in their books of accounts. Then the auditors are required to consider the database which are maintained by the respective entities with regard to right of use assets. So similar kind of information is required to be maintained for right of use assets which are being maintained for normal PPE in case of those entities who are following Ind AS. So this is one of the key aspect or one of the important audit aspect which the team is required to consider, because it has been observed many a times team members misses on this particular parameter. They believe that ROU is not a PPE, and on the basis they don't consider it for the purpose of verification or for the purpose of reporting under this clause. So friends, please be cautious, please be aware that this is also required to be considered by you while giving your final view on reporting this particular clause. And it has been observed that many times people miss this reporting. So we have to be very cautious because Ind AS is new. So when I say new, it's almost like more than 5 years is there down the line, but still, and CARO 2020 has already settled by 3 years by now. So this is one of the important aspects which has to be covered by the team members. Then physical verification of inventory, stock in trade has been captured here as a part of inventory for the purpose of verification and required reporting. Moving forward, revaluation of PPE and intangible assets. This is a new clause which has been inserted in CARO 2020 as compared to CARO 2016. So it requires that whether any valuation has been done by a registered valuer, and if the change is of more than 10%, the reporting, the required reporting is required to be mentioned in the CARO report. So what do you mean by registered valuer here? One of the key aspects is many a time people believe that registered valuer means any valuer can be there, but you have to be cautious. Registered valuer in those scenarios will be the valuer which is getting covered under the provision of Companies Act 2013. The Companies Act prescribed or defines what is meant by registered valuer. So friends, you have to be cautious. You have to take care that even though the valuation has been obtained by any valuer, but they are not fitting into the definition of a registered valuer under the provision of Companies Act 2013, then the reporting is required to be modified accordingly. Then clause with regard to Benami transaction. This is a new clause which has been inserted by CARO 2020. It says that whether any proceedings have been initiated or are pending against the company for holding any Benami property. So this is a new clause which have been inserted by CARO 2020. I'll request all of you to please go through the guidance note in detail with regard to this particular clause and ensure in case of any company, if any Benami transactions are there and whether it requires adequate reporting or not. So what do you mean by Benami transactions, or under which scenario or what to be reported? That has been adequately prescribed in the guidance note. Then physical verification of inventory, it has been modified. In the opinion of auditor, whether coverage and procedure of physical verification is appropriate or not. And then material discrepancies have been replaced with the terminology discrepancies of 10% or more in the aggregate for each class of inventory. So if you have various classes of inventory, class A, class B, class C, for example, or maybe for trading stock, separate records for finished goods, then in that case, if there are discrepancies of 10% or more, then the reporting is required to be given. So there is a reporting requirement at length on this particular clause, which has been specified in CARO 2020. CARO 2020 covers, it says, whether physical verification of inventory has been conducted at reasonable intervals by the management, and whether in the opinion of the auditor, coverage and procedure of such verification is appropriate, and whether any discrepancies of 10% or more in the aggregate for each class of inventory were noticed, and if so, whether they have been properly dealt with. So if you will see, the clause is one clause, but there are various parameters which are prescribed in the clause. So almost like there are 4 sub clauses or 4 sub paras in this particular clause, which are required to be evaluated by the auditor, and each clause is required to be reported in the audit report. We should not miss out on this particular aspect. So though it appears that there are only 21 clauses in the CARO 2020, but in 21 clauses, there are subclause A, B, C, D in the respective clauses. And even in those clauses, in A or in B, there will be many matters which are getting covered in the questionnaire, which are required to be reported by the auditor. So it should not be missed out by the audit team. Then quarterly returns or statements filed by the company. There's a new clause which has been inserted by CARO 2020. Here it says that if the sanctioned working capital limit is greater than ₹5 crore against the security of current assets, report whether quarterly return or statements are filed with the lender are in agreement with the books of accounts or not. So here, one of the key aspect or important audit aspect which team members should take it into their consideration, it says that working capital limit. So normally people believe that it talks about the working capital loan. So it is not about the working capital loan which is availed by the company. Even if the term loan which is availed by the company, which is for the general purpose of the company or for the general business or the working structure of the company, even that will be getting covered for evaluating the reporting requirement under this clause. So if, for example, if the term loan has been borrowed by the company for an amount of ₹20 crore and there is no specific criteria which has been specified in that, even that will get captured into this particular clause because it is obtained by the company for the generic purpose, for the business purpose, for the working capital. Then it will get captured here for evaluating and for reporting. Then second thing, it says against the security of current assets. Now, friends, what do we mean by current assets? When we read this terminology, the first thing which clicks to our mind is stock and trade. Current assets means stock and trade. So in normal scenario, we presume that if the loan has been obtained by the company, working capital which is exceeding more than ₹5 crore on the stock and trade, then only the reporting requirement will get triggered. So there can be different situations where the current assets can be different. We have tried to cover here that particular aspect in this particular slide. So the first question will be from my side that whether immovable properties should be considered here on the basis of which loans have been obtained. Many a times the audit team misses out on this parameter. They believe that immovable property is not part of the current asset, and accordingly, or immovable property is an immovable property. When they have said current assets means only the movable assets. That is not the correct way of understanding or interpreting. There can be scenarios, for example, in case of real estate companies, immovable properties like inventories comprises of buildings. So there will be buildings which are immovable properties, which are part of inventories in the real estate companies, though they are not movable in nature. They are current assets from the perspective of that particular company. And if a real estate company is obtaining loan from a bank or a financial institution which exceeds more than ₹5 crore, on the basis of those inventories, this clause will get triggered and the reporting requirement will have to be evaluated by the audit team. So this is something which you will have to consider while you carry out the audit process in case of a real estate company. Second thing, whether it covers reporting on term loan, I have already described in detail. it should not only be thought of that only working capital loan will be covered here. If the term loan has been obtained where no specific purpose has been specified in the loan agreement, and if it is substantiated that it is for generic business purpose, yes, it will also get captured here. Whether borrowings made on the basis of security given of loans in advance will get captured here for the purpose of reporting. So again, if we look at from a different perspective from a normal company, if a loan is given by a particular company to any third party or any related party, the loan will appear into loans and advances. And normally the loan is not taken on the basis of loans and advances by such kind of companies. However, in case of NBFCs, loans will be taken on the basis of loans and advances because loans and advances will be like a kind of a trade receivable for them. They are giving the revenue. They are the part of the business operations of those NBFCs, where the business modality is to give the loan, and those loans will be considered as a part of current assets. And if the NBFC is obtaining loans on the basis of security given in the nature of loans and advances, yes, that will also get captured here for the purpose of reporting for that particular entity. Another important point which we should consider as a part of the audit process, working capital can also be non-fund based. So it is not necessary that only fund based, like actually whatever we have received as a part of loan in terms of cash in our books will be covered here. There can be scenarios where working capital can be non-fund based, where there is no immediate outflow of funds from the lender, which includes LC or bank guarantees. So these are some of the key aspects, some of the important audit aspects which the audit team will have to consider while evaluating and reporting on CARO 2020 parameters. Moving forward to the next slide. Investments, loans, security or advances in the nature of loan. There's a new clause which have been inserted in CARO 2020 where the reporting requirement is also required to be given with regard to loans, etc., given to subsidiary, joint venture associates or other parties. So this is altogether a new clause. I am not touching upon this particular clause in detail, but this is quite comprehensive clause, and reporting under clause 3A is exempted for those companies whose principal business activity is to give loans. So for example, those NBFCs who are, so it mainly will be getting exempted for NBFCs because the business of NBFC is to give the loan. That's the principal business of the NBFC. There can be certain entities who may not be NBFC, but they may have their principal business, one of the principal business to give loans. Even in those cases, the clause 3A for reporting requirement may not get triggered. It will have to be evaluated by the auditor on the basis of facts and circumstances that whether it gets triggered under those scenarios or not. Then clause 3B, investments, loans, security or advances in the loans in the nature of loans are prejudicial. This is a modified clause. So this has been extended from loans to investment, security and advances in the nature of loan. Earlier it was only in the nature of investments. Now loans in the nature of loans. Now it is in the nature of investment, security and advances also. So many a times here, if we take on this particular clause, the important aspect which has to be seen, that company A Limited has made investments in company B Limited. For example, investments are of 100 crore. And when the investments are being made by company A into company B, those investments are, for example, investments by way of preference shares, by subscribing preference shares. Now, the preference shares does not have any kind of return in the nature of dividend. So if there is no return in the nature of dividend, or there is no adequate consideration when these preference shares will get redeemed, presuming the preference shares are redeemable, compulsory redeemable, then the question will trigger that why these investments are not prejudicial, why the company has made investments of rupee 100 crore where it is not generating any returns. or maybe there may be a scenario where the returns are being generated. For example, the dividend on the preference shares are like, for example, 2% or 3%, but they may not be adequate uh, in comparison to the market rate, where the returns would have been received by the company much in a much better manner. So even in those cases, it can be prejudicial to the interest of the company. So those cases are required to be evaluated appropriately, and then adequate reporting has to be made. So it should not be simply seen that, okay, investment have been made, it will be not prejudicial to the interest of the company. However, there can be different situations. For example, investment is made in the preference share, and those preference shares are convertible preference shares, and this will get converted into equity. And there will be some variable dividend right which is linked to that, or variable voting right which gives better power. And if we compare on a long term basis, and if we found that the returns which we are getting from those investments are not prejudicial to the interest of the company on a holistic basis, then this reporting may not get triggered under those scenarios for those particular entities where investments have been made by those entities. Then another clause, repayment of principal and payment of interest, whether stipulated and regular. So this clause has been extended from loans to advances in the nature of loan. Earlier, it was only capturing the loan transaction. Now the reporting requirement has been extended, the horizon has been expanded, and now it covers advances in the nature of loan. So many a times it happens that company gives advances for buying a particular property, but those advances are lying as it is in the books of accounts for a long period of time, and it cannot be substantiated that what is happening further after the funds have been given to that particular party. So, for example, 1 year has passed away, or 2 years, or 3 years, or 4 years. However, no material development is taking place towards that particular advance. Like it is not getting converted into the actual property, or it is not coming back to us. So in that case, it will take color of advances in the nature of loan. So the auditor will have to evaluate carefully the kind of contractual arrangement entered by the company, the duration within which those advances will get converted into the requisite asset, or it will be remitted back. And if it is not getting converted or remitted back, it will get covered into the category advances in the nature of loan. The color of that particular transaction will get changed, and it will require reporting under this particular clause. Then overdue interest and principal for more than 90 days, there is no change in this particular clause. Overdue loans or advances in nature of loans, and loan term extended or fresh loans given to repay such loan. So this is a new clause which has been inserted by CARO 2020. It says that where the loans or advances in nature of loan granted, which has fallen due during the year, has been renewed or extended. So any loan which has been granted earlier has been extended or renewed during the year, or a fresh loan has been granted to settle the overdue of existing loan. So if you evaluate the situation, there can be various probabilities. One, fresh loan has been given during the year by the company. Second, the loan was already given earlier, however, it has been closed, and another loan has been given towards that particular loan. So it can be clearly, nexus can be clearly brought out in those kind of situation. So even in that case, the reporting requirement will get triggered. Third situation, the loan has been renewed. So it has not been closed, it has not been extended. The loan has been renewed. Or fourth, fresh loan altogether has been given. So in those scenarios, the clause will get triggered for the purpose of evaluation and reporting requirement by the auditor. So it will not be a simple criteria where the loan has been given. If the various parameters under different situation are also getting triggered, then also the reporting requirement will get triggered here. However, this clause is not applicable to those companies whose principal business is to give loans. So if the principal business is to give loan, then it will not get applicable. Otherwise, it will be applicable for the purpose of reporting. Loans or advances in the nature of loans either repayable on demand or without specifying any terms or period of repayment. Again, there's a new clause. It says if there are loans which have been granted where no repayment period has been prescribed or the loans are repayable on demand. So friends, many a times it has been observed that the loans which are given by the companies to its related parties, related entities like subsidiaries or associates or joint ventures, many a times the repayment period is not prescribed. So the factual reporting is required to be done in this particular clause. It is not a negative reporting, but it's a factual reporting that yes, loans have been given by the company which are repayable on demand or where the repayment period has not been prescribed. So this is something new reporting requirement which has been brought in by CARO 2020. And the important aspect here is to understand and evaluate the kind of loan agreement entered by the company with the respective borrower. And if this clause gets triggered, the reporting parameters are prescribed into this clause, which are required to be reported, like total value of loans granted, aggregate amount of loans granted to promoters and related parties is defined in section 276. So this is something which is important. So the reporting requirement further gets segregated with the promoters and related parties in respect to the loans given to them. In regard to compliance of section 185 and 186, there is no change. The reporting requirement still remains the same. Then with regard to public deposit, new phrase has been added, which says deemed public deposit. So deemed public deposits are also required to be covered here for the purpose of reporting. So what do you mean by deemed public deposit? Friends, if we see this, Companies Act, under the provision of Companies Act, acceptance of public deposit rules have been issued by the regulator. So in those acceptance of public deposit rules, various categories of transactions are prescribed which are considered to be deemed as public deposits if certain situations will get fulfilled. So if those conditions will get fulfilled, though in substance those transactions are not falling into the nature of public deposit, they will be considered as public deposits. They will be considered as deemed public deposit. And under the provisions of CARO 2020, they will also get evaluated for the purpose of reporting. So we should not miss out. So this is one of the key aspect or one of the key audit aspect which the audit team will have to carefully evaluate and document in their work paper. So for example, share application money which has been taken by the company, and if it crosses the threshold period as prescribed under the provision of Companies Act, it will be considered as a part of deemed public deposit, and this will also require reporting under this particular clause. So on face, it may appear that these are application money. However, because the period has breached and those application money has not been converted into the equity share or has not been remitted back to the company, in those circumstances, it will be considered as a part of deemed public deposit. There's one of an example. There are various scenarios which are prescribed or there are various provisions which are covered under the guidelines under the public deposit rule, which team members will have to go through carefully. About disputed statutory dues, a minor modification is there, not much change is there. So statutory dues or disputed statutory dues, GST has been added. Otherwise, the reporting requirement is same. Here, one thing should be carefully considered. So the requirement is in case of undisputed statutory dues, which are outstanding for more than 6 months, reporting has to be made. So I'll give a practical example here, which many times team member misses out while carrying out the audit. For example, if a company has a total tax liability of 1 crore at the end of the financial year on the basis of its actual profit, so accordingly, it is required to pay 30% of advance tax which is 30 lakh rupee by 15th of September. So we have 15 June, 15 September, 15 December, and then 15 March. So if the advance tax paid by the company is in this situation is 20 lakh rupee, then if we can observe here that rupee 10 lakh is the deficit, and which are outstanding as on the balance sheet date, which is outstanding for more than 6 months. Because more than, when we say more than 6 months, the advance tax payment got triggered on 15th of September for 30% of the total income, total taxable income, which is 30 lakh rupee in the given example. Here in the given example, the company had only paid 20 lakh rupee as on the balance sheet date. So there is a deficit of 10 lakh rupee. These dues are undisputed dues. They are also required to be reported here while reporting under this particular clause, that advance tax not paid for more than 6 months as on the balance sheet date, which is of 10 lakh rupee, because the due date was 15 September and 1st October, from 1st October onwards, more than 6 months reporting requirement gets triggered. So this is also one of the important aspects teams will have to evaluate and to see, and it is very easily identifiable and visible in those cases where advance tax could not be paid because of any reasons by the company. So there may be a possibility that company don't have adequate cash flow, or there is a liquidity crunch and it could not have paid the advance tax within the adequate timelines. Compliance of section 185 and 186. The key changes in the guidance note: provision of one section 185 shall not apply to a private company in those cases whose share capital does not cover the shares or the investments from any body corporate. If the borrowings of such a company from banks and financial institution, or borrowing is or from any body corporate is less than twice of its paid up share capital, or 50 crore, whichever is lower, and such a company has no default in repayment of such borrowing subsisting at the time of making such transactions. So in those cases, provision of section 185 shall not apply. Transactions not recorded earlier, surrendered or disclosed during income tax assessment. So there can be scenarios where, for example, raids have been carried out by the income tax department. Many times it happens that raids have been carried out by the income tax department, or the search has been carried out by the income tax department, and the company discloses a particular amount to the income tax department, and then they pay off the taxes. So for example, we are in financial year 24-25, and the search has been carried out on a particular company for the financial year 21-22, and the company has agreed for X amount of taxes to be paid for 21-22. So in those cases, whatever income which has been offered by the company is also required to be brought in into the books of accounts in the financial year 24-25 during the period when they have offered the income and they have offered the taxes on those income. So transactions not recorded earlier, surrendered or disclosed during income tax assessment should be adequately covered, and the reporting is also required to be made by the auditor in those scenarios. Then default in repayment of loans or other borrowings, or in the payment of interest. This clause has been modified. This has been extended on default in payment of interest also. Earlier it was only with regard to repayment of principal. This clause is now applicable to all the borrowings. Earlier it was applicable only on borrowings taken from financial institution, bank, government, or dues to debenture holders. So this is one of the key change which has been brought in under CARO 2020, and this is a reporting requirement. So we will also make comparison when we will cover up in subsequent slides interplay of CARO 2020 with Schedule 3. So we will also see which are the key clauses in CARO 2020 which are also getting covered into Schedule 3 reporting in the financial statement, and there are commonalities or uncommonalities. So we will touch upon those clauses separately in subsequent slides. So this is one of the clauses which will also get covered into that particular slide. Willful defaulter, this is again a new clause which has been touched upon in Caro 2020 for reporting requirement. It has to be carefully identified and evaluated by the auditor while framing their view on this particular clause. And this will be more relevant in those cases, those corporates who are finding difficulty in terms of their going concern or liquidity challenges are there. So, I mean, it gives a kind of sense that there can be a possibility. And if there are defaults on the company side in repayment of uh, their debts or payment of interest to the banks or financial institutions. This also covers any other lender. Application of term loan taken. So this has been modified in Caro 2016. Clause wise, it has been included with application of money raised by way of IPO or FPO. And if loan is not applied for the purpose, so earlier it was only reporting requirement with regard to term loan. Now the term loan and the IPO related parameters have been segregated. So it has been splitted and shown separately and covered here separately for the purpose reporting under Caro 2020. Utilization of fund raised on short-term basis. This is again a new clause which has been inserted under Caro 2020. So it has to be evaluated whether the funds have been raised on short-term basis, have been used for long-term basis or not. Then loan taken to meet obligation of subsidiaries, associate or joint ventures. So many times there is a possibility that a company will have subsidiary, associate or joint venture. So those cases where there are subsidiaries, associates or joint ventures, this clause will get triggered. Those cases where there are none of these entities, this clause will not get triggered for the purpose of reporting. So if a company has taken loan to meet obligation of its subsidiaries or associates or joint ventures, then it is carefully required to be evaluated by the audit team and adequate reporting is required to be done in those scenarios. This is a factual reporting. It is not a negative kind of statement. Then 39F says whether the company has raised loans during the year on the pledge of securities held in its subsidiaries. So many times there is a possibility that the subsidiary company will hold certain investments and on that basis the parent company has taken loan. So if that scenario has got triggered, the audit team will have to carefully evaluate that and will have to report adequately in the particular clause. And then adequate reporting requirement has to be maintained and to be disclosed. So if this clause is getting triggered, the reporting requirement gets triggered, then there are various informations which are required to be disclosed as per the requirement of Caro 2020 and guidance. So for example, if such loans has been raised, then details of such transaction to be reported and also to report in case of default and repayment of such loans. IPO, FPO, we have already discussed that its utilization or non-utilization is required to be reported adequately by the auditor in Caro 2020 report. Preferential allotment or private placement. So if there is a preferential allotment or private placement, that is also getting triggered for the purpose of reporting in Caro 2020. This clause has been modified in Caro 2020. Managerial remuneration clause, this is the only clause which has been deleted as compared to Caro 2016. So friends, we are comparing here between Caro 16, Caro 20 and during that comparison, we are also touching upon on the key aspects or the audit aspects of the relevant clauses wherever it's found suitable. So fraud, this is one of the important clause and this is a clause which is very carefully being looked upon by the regulators nowadays. Whenever any inspection is being carried out or whenever any investigation is being carried out by the regulator of the financial statement of any of the particular entity. So earlier the fraud reporting requirement in Caro was covering only the fraud which was carried out on the company by its officers or employees. Now it covers the reporting requirement. It covers the reporting with regard to any of the fraud which has been carried out by any of the party. So it doesn't make any difference if the fraud is carried out only by the officer or employee of the company. So what does it mean here? And under which scenario the third situation can emerge? So, for example, in case of NBFC, the customer had done some kind of fraud. So, for example, the customer had given the forged document while taking loan, or forged loan agreement, forged property related agreement, or any other document. Then in that case, the fraud has been done by the customer. It's not being done by the company, its officers, or its employees. So in those scenarios, earlier the reporting, such kind of reporting was not getting triggered in Caro, whereas now it will get reported in Caro 2020. So even though the fraud is being carried out by the customer, it will have to be reported here. Though in ADT4 it will not get reported, because ADT4 requires any fraud which is identified by the auditor and which exceeds more than ₹1 crore. However, in case of NAFRA-based entities, irrespective of the fact that the fraud has been identified by the auditor or not, if the fraud is of more than ₹1 crore, and if it has been carried out by the company or its officers or employees, then the auditor is under compulsion to report it to the regulator. Auditor is under compulsion to file ADT4 with the regulator. So, I mean, this is one of the key aspects, and friends, you should be very well aware with regard to reporting requirement under fraud and filing of ADT4 with regard to fraudulent transactions. So I hope it's clear to everyone. I'll repeat again for the benefit of all, because it is one of the important clause and it is very carefully being looked upon by the regulator. So in case of reporting under clause 311A, the reporting is required to be done for all kind of fraud instances, whether it is carried out by the company, by its officers or employees. So in the given example, if the fraud has been carried out by the customers, it will get captured here for the purpose of reporting. Whereas in case of filing ADT4, the ADT4 will get filed with the regulator only when the fraud has been identified by the auditor and if the amount is of more than ₹1 crore. But this situation will exist only in case of those entities which are non-NAFRA based entities. Those entities which are covered under the purview of NAFRA, irrespective of the fact that the fraud was identified by the auditor or not, if the fraud amount is of more than ₹1 crore and if it has been carried out by the company or its officers or employees, the ADT4 is required to be filed by the auditors with the regulators, and in those circumstances, reporting requirement will get triggered under this particular clause of CARO 2020. I hope, friends, you are clear with this particular clause. We'll move forward to the next clause. Whistleblower complaints. If there's a new clause, again, I mean, many times I have found that people gives a miss to this particular clause because they believe that if there is a vigil mechanism in the company, then only the reporting requirement will get triggered here. But friends, you should understand carefully and look into the requirement appropriately, that it says if there are any whistleblower complaints, whether it has been adequately covered by the company or not. So it says that whether the auditor has considered whistleblower complaints, if any, received during the year by the company. So it doesn't say that there has to be a vigil mechanism. So there may be a scenario where the company may have a vigil mechanism. There may be a scenario where a company may not have a vigil mechanism. So in certain cases like listed companies and all, where by compulsion vigil mechanism policy is required to be maintained and the procedure is required to be followed, it will be there. But in those cases where vigil mechanism is not there because it is not mandatorily required, still in those cases, those corporates, whistleblower complaints can be there. For example, in case of a private company, though vigil mechanism is not there, which is not required as per the statute, there can be whistleblower complaints. There can be complaints by the employees, by any external parties, etc. So the auditor has to carefully evaluate and has to inquire with the management and to evaluate the documents, minutes, etc. so as to understand that whether there are any whistleblower complaints or not. So even though visual mechanism is not there, it is the duty of the auditor to understand, to evaluate, to inquire, and then to adequately report on this particular clause. I hope it is clear. It is very important clause, and nowadays whistleblower plays a very important role. Many kind of frauds or gaps are being noticed on the complaints of the whistleblower, and they have to be taken very seriously. It should not be omitted by the auditors. Again, there can be financial implications. So whistleblower complaints can be many. May have financial implications. They may not have a financial implications. For example, whistleblower complaint in the nature of cost. It may not have any financial implication. However, it is required to be seen that the whistleblower complaints have been adequately considered by the company. So this is one of the important clause for evaluation and for reporting. Nidhi company, I'll just give a miss to this clause. It's not very common. Defaulting payment of interest or repayment of deposits. Details to be reported if there is default in payment of interest or repayment of deposits for any period. So there's a new clause which has been inserted in CARO 2020. Related party transactions, no changes there. Internal audit, there's a new clause which has been inserted. So whether the company has an internal audit system commensurate with the size and nature of its business. So friends, here the key aspect while carrying out the audit will be you should thoroughly go through the scope of the internal auditor. So there may be a possibility company may have an in-house internal audit team or may have an external team, a team of external professionals. So there are criteria to whom there are criteria in cases where internal audit is applicable to a certain set of companies. So if internal audit is mandatory, then it is very much the need for the auditor to evaluate whether the internal audit system commensurate with the size and nature of its business or not. And that can be evaluated only by going through the scope of the internal auditors, which normally is being agreed upon at the beginning of the financial year. So as a part of process, auditors should look into this, should meet the internal auditors, should carry out inquiries with the internal auditors, and then should give the adequate reporting on this particular clause. So if the auditor finds that the scope is not appropriate, not suitable, can insist to the internal auditor to enhance the coverage of the internal audit at the beginning of the year, so that at the year end, such kind of gaps can be avoided for complying with this reporting requirement. Then whether the reports of the internal audits for the period under audit were considered by the statutory auditor. So auditor will have to go through it and will have to appropriately report on this particular clause. Then about non-cash transactions, no change. Registration under 45A. 45A deals with the requirement for those entities who are in the nature of non-banking financial operations. So if those which are NBFI, non-banking financial institutions, they are required to register themselves as NBFC under 45IA. And for that, friends, there is a criteria under the RBI guidelines, 50-50 criteria. So again, this is one of an important aspect which has to be looked upon. It has been observed many a times in case of shell companies. So when I say shell companies means those companies where there are not much of revenue related activities or operating activities, and the threshold of 50-50 criteria, like 50% in terms of income from financial activity and 50% from holding the financial assets are reached simultaneously in respect of the previous financial year. So if that is getting triggered, then the registration requirement will also get triggered under 45A. An auditor will have to carefully evaluate the financials of last year while reporting under this particular requirement. So auditor should not give a miss if the 50-50 criteria has been met as on the balance sheet date of the last year and the registration has not been obtained by the company, then the adequate reporting requirement will have to be made. So this is one of the key audit aspect which has to be looked upon. Again, it has been observed many a times this is being missed out for whatever reason, with a general presumption that this is a company which is not required to get registered under RBI. It has no activity where any interest income or the financial institution related activity is being carried out by that company. So that is a careful evaluation which is required to be done by the auditors. Functions of non-banking finance company or housing finance company. This is a new reporting requirement. So this clause says whether the company has conducted any non-banking financial activity or housing finance activity without a certificate of registration. So if a certificate of registration has not been obtained, then a reporting requirement is getting triggered here. Core investment company, there's again a new reporting requirement which has been inserted here. Core investment company criteria has been prescribed by RBI, and if the company is exempted from registration of CIC, whether it fulfills to continue such criteria is required to be evaluated. So whether the company is a CIC or as a part of a group where more CICs are there, so for that purpose, the company will have to seek the entire tree or the structure of the group and will have to inquire which are the other CICs in the group, and then basis that adequate reporting is required to be carried out for this particular clauses. Then cash clauses, this is again a new clause as compared to 2016. So if the company has incurred cash losses, then the reporting is required to be given for the current year and for the previous year also. So there can be a scenario during the year there is a cash loss, in the comparative year there is no cash loss. Still you will have to report during the year there is a cash loss, comparative year there is, or the preceding year there is no cash loss. Vice versa, during the year there is no cash loss, but in the preceding year there is a cash loss. So in that scenario also you will have to report it. So you should not miss out. अगर इस बार नहीं दिया है, इस साल में अगर कोई कैश लॉस नहीं है, तो हमें पिछले साल देने की जरूरत नहीं है, ऐसा नहीं होगा. सो फ्रेंड्स, ये आप प्लीज ध्यान रखिएगा. आपको दोनों सालों के लिए इवेल्युएट करना है. यू हैव टू इवेल्युएट इट फॉर बोथ द इयर्स and then you have to report it for both the years appropriately. This is the clause where the reporting requirement is getting triggered for both the years. Otherwise, in all the clauses, the reporting requirement is only for the current year. And then the amount of cash losses are required to be reported. Resignation of statutory auditors is a new reporting requirement which is getting triggered in CARO 2020. So in case of listed companies, there are separate guidelines with regard to resignation of statutory auditors. Auditors should go through that. I mean, though it's not a compulsion, but they should go through that whether those have been fulfilled or not. In case there is a resignation of the statutory auditor during the year, and in case of unlisted company, the simple resignation letters will be there. So as a part of the process, auditors should go through the resignation letters of the auditor filed with ADT, one form with the regulator. ADT 3 form filed with the regulator. So that has to be seen, and also should carry out the inquiry with the previous auditors if needed. That are there any indicators which should be considered by the auditor for the purpose of reporting under this clause. Though NOC will be sought by the auditors, so NOC will also act as a good process that will act as an additional process to say there were any reasons or not for reporting under this clause. Capability of company to meet its liability. This is a new clause. This is a very important clause. So here the auditors will have to look into the various parameters, the financial issues, aging, etc. And then basis that the auditor will have to report that whether the company is capable of meeting its liabilities when they fall due within a period of 1 year from the balance sheet date. यानी कि आपको बैलेंस शीट डेट से देखना है कि आने वाले 1 साल के पीरियड के अंदर जो उसकी आज की लायबिलिटी है वो पे ऑफ हो पाएगी या नहीं हो पाएगी, बिकॉज बेस्ड on the base of all the available parameters as on the balance sheet date. Friends, for this particular clause or for many of the other clauses, you will also have to take care of the SS 720 requirement. So what do we mean by SS 720? I mean, again, this is one of the key aspect or one of the audit aspect. So SS 720 requires reporting on the other on the other matters which are reported in the audit report. So not other matters, I mean the other information which are being reported in the along with the audit report, along with the annual financial statement in the annual report. So other informations which are being issued by the management, so like MD&A, director's report, etc., they may cover certain set of information which may trigger for you to evaluate and to consider whether, so for example, for this particular clause, that whether the company will be able to meet its liability or not. For example, in the director's report or in MD&A or in any of the other reports circulated along with the financial statement, it is stated that the company does not have any plan to carry on its business operation in near future, or the major portion of its is going to be hived off by way of a restructuring, by way of a demerger, etc., then there may be a possibility that this clause, reporting requirement in this clause will have to be evaluated thoroughly. There may be a possibility that company may not be able to meet out its liability within next 1 year from the reporting date. So SS 720 also plays an important role so when I say important role means for evaluating, for exploring and for documenting the entire work process, that okay, all the parameters have been evaluated, and then you can say that the reporting which you are doing under this particular clause is adequate. So if your file gets picked up under any of the inspection by any of the regulator, maybe by FRRB, QRB or NAFRA, etc., I mean, under this clause, please be cautious that this clause or many of the other clauses, that while verifying the requirements under SS 720 for other information, the holistic approach is also being evaluated with regard to the reporting which has been made for CARO 2020. Then transfer of unspent CSR amount with regard to ongoing project and other than ongoing project. This is a new clause which has been inserted. It's a factual statement which is required to be reported. Resignation of statutory auditor, this has been removed from the guidance note. And then capability of the company to meet its liability. So, like as I told you, SS 720 should also be considered by the auditor while reporting under this clause. This is one of the important things. Then, friends, now we are coming to the last slide of this particular aspect of our session. We will move on to the another slides. The last reporting requirement in CARO 2020 is with regard to the negative remarks which were given by the auditors of the components. So if the auditors of the components have given any negative remark in the consolidated financial statement, it is required to be reported. This is a new clause which has been reported, which has been included for the purpose of reporting. So if there are any adverse remarks or qualifications given by the auditors of the respective companies which are consolidated, then the auditor of the holding company is required to indicate the para number of the CARO report containing the qualification or adverse remarks. So the reporting requirement says कि कौन से clauses में, so आपको क्या करना है, for example किसी company की for example 25 subsidies हैं, so आपको उन subsidies के audit report के through go through करना है. You have to go through each of the clauses of the audit report of those subsidies, each of the clauses of CARO report of those subsidies, and you have to identify what are the negative remarks or the adverse remarks which were given by the auditor of those components, and then you will have to specify that these are the clauses in these respective entities, these are the CAN numbers where the negative remarks have been given by the auditors in their CARO report. So this is something which is very important. Here you have to be cautious in case if there are LLPs or partnership firms or foreign companies where CARO 2020 is not applicable to those entities because they are not companies or they are not companies incorporated in India, then you will have to specify that the reporting requirement is getting triggered only in case of those companies or those components which are incorporated in India. Now, friends, we'll just take a pause for a minute. This slide differentiates the earlier slides and the subsequent slides which we are going to capture in our today's presentation. So here, this slide covers a gist of the clauses which are having a commonality with the Schedule 3 requirement. So till time we have covered the reporting requirement in CARO 2020, key aspects, key audit aspects with regard to those clauses and how it has to be identified, verified and evaluated for the purpose of reporting. Here we will see these 10 clauses where there are commonalities with Schedule 3, and those clauses either will have some additional reporting requirement in CARO 2020 or will have some differential reporting requirement in CARO 2020 as compared to Schedule 3. So as we know, Schedule 3, there are three different Schedule 3s, Schedule 1, Schedule 2, Schedule 3. So Schedule 1 is for those entities who are preparing their financial statement as per IGAAP. Division 1 of Schedule 3 is applicable to those entities who are following IGAAP for preparing their financial statement. Division 2 to Schedule 3 is applicable to those entities who are following Ind AS as a part of their reporting framework. And Division 3 to Schedule 3 is applicable to those entities who are financial institutions like NBFCs, etc. So CARO 2020 is same for Division 1, for Division 2 or Division 3 entity. However, there will be differentiation between CARO 2020 and Schedule 3, or there will be commonalities between both of them. So the first one, if we see, the CARO 2020 requires whether the title deed of all the immovable property other than properties where the company is the lessee and the lease agreements are duly executed in favor of the lessee disclosed in the financial statement are held in the name of the company, if not prescribed details. Okay, so CARO 2020 says the title deed of all the immovable property disclosed in the financial statement are held in the name of the company or not. If not, then give the adequate disclosure. Schedule 3 says disclosure of details of title deeds of immovable properties, excluding lease properties, not held in the name of the company in the prescribed format. So the format will be deviating to some extent, but the reporting requirement is one and the same between CARO 2020 and Schedule 3. Schedule 3 also requires to give disclosure of those title deeds where the title deeds are jointly held by the company. So there may be a possibility that company ABC Limited and company XYZ Limited are holding one particular property jointly. So they are joint owners. In those cases, those details are required to be reported or disclosed adequately in the financial statement as a part of notes to accounts under the requirement of Schedule 3. So there is no uncommonality between both the reporting requirements for this particular clause. Then friends, second point, whether the company has revalued its property, plant and equipment, including right of use assets or intangible assets or both during the year. So this is a reporting requirement in CARO 2020. And then it says, if so, whether the revaluation is based on the valuation by a registered valuer, specifying the amount of change, if change is 10% or more, in the aggregate of the net carrying value of the each class of PPE or intangible assets. This is a reporting requirement in CARO 2020. Now, if we see the comparative part of it with Schedule 3. So when we say Schedule 3, the disclosure which is required to be given into the financial statement. The disclosure regarding revaluation of PPE intangible assets, it says amount of change due to revaluation if change is 10% or more in the aggregate of the net carrying value of each class of PPE or intangible assets. So if we compare this clause with the reporting requirement in CARO 2020, there is no deviation. The reporting requirement is one and the same. Further, whether revaluation is based on valuation by a registered valuer. So in both the scenarios, in CARO 2020 and in Schedule 3, in both the cases, it has to be seen that the valuation has been carried out by a registered valuer. So it is very important that you evaluate, you understand who is the registered valuer under the provision of Companies Act 2013, and the valuation has been carried out only by such kind of registered valuer. It cannot happen that all the valuers will give the report will be considered here. It is a specific requirement that the valuer has to be a registered valuer under the provision of Companies Act 2013, and then only report of those valuers have to be considered for the purpose of reporting under these two clauses. If the report is not issued by a registered valuer, then adequate reporting is required to be made for this particular clause. Then, whether any proceedings have been initiated or pending against the company for holding any Benami property. So friends, here there is no uncommonality between CARO 2020 and Schedule 3. The disclosure requirements are one and the same. So one is CARO 2020, then the Schedule 3. So it says disclosure prescribed for proceeding initiated pending for holding any Benami property, example like details of such property and amounts thereof, details of beneficiaries. If property is in the books, then reference to item in the balance sheet. Property is not in the books. So there can be a scenario, there's a Benami property which is there in the books, then the tagging of that particular asset in the disclosure. If those assets are not in the books, then give the facts along with the reasons why it is not there, details of proceedings and nature of proceedings, status of same and company's view. So this is a quite comprehensive disclosure which is required to be given in the financial statement from the company's side as a part of requirement of Schedule 3. So CARO 2020 says that appropriate disclosure has been made in the financial statement. And what do you mean by appropriate disclosure? These are the appropriate disclosures which are required to be given by the company in the financial statement. So if these disclosures are made adequately and to its fullest, then in CARO 2020 reporting, we can say that appropriate disclosure has been made in the financial statement. So to that extent, there is no uncommonality between both these clauses. Now, friends, if we come to this particular clause, there is a deviation between CARO 2020 and Schedule 3. CARO 2020 says whether during any point of time of the year the company has been sanctioned working capital limits in excess of 5 crore rupee in aggregate from banks or financial institutions on the basis of security of current assets. Whether the quarterly return or statements filed by the company with such banks are in agreement with this, if not, give details. So we have discussed this clause at length in our previous slides, and we also understood the key aspects, key audit aspects with regard to this particular clause. Now, if we compare this clause with the reporting requirement under Schedule 3, it says in case of borrowings from banks or financial institutions. The key differentiating factor here is it says borrowings and it says the company has been sanctioned working capital limit. So here it covers all kind of borrowings, whether it is in the nature of debentures which have been acquired by the financial institution, like company has issued the NCDs, or in case of any loan which has been taken from the bank or financial institution, which can be short term, long term, which can be for a specific business purpose, which is not for working capital, etc. Then also the disclosure is required to be given herein with regard to those borrowings. Here it restricts only with regard to the loans which have been obtained towards the working capital. Here it refers to the loans which have been obtained from banks or financial institutions under all categories, so all kind of borrowings. Current assets, it remains the same between both the reporting requirements. Then here it says in excess of 5 crore, here there is no limit. So here in Schedule 3, if we see, even if you have borrowed an amount of rupee 1 crore from, for example, SBI Bank, it will get covered here for the purpose of reporting. That will not get covered here for the purpose of reporting because the amount of borrowing is less than rupee 5 crore, even though it has been borrowed as a part of working capital. So this is a key differentiating factor here. So if we see CARO 2020 prescribes reporting requirement relating to sanction working capital limits in excess of 5 crore, what we have discussed in aggregate. However, disclosure requirement under Schedule 3 are not limited to working capital, but cover all borrowings, what we have seen. So 5 crore, no limit, working capital, all borrowings. This is the segregation between between CARO 2020 and Schedule 3. No monetary threshold has been prescribed under Schedule 3 to the Companies Act while making this disclosure. Then, so there was a differentiating factor between that clause for reporting in CARO 2020 and Schedule 3. Then moving to the next clause, whether the company has granted any loans or advances in the nature of loans either repayable on demand or without specifying any terms of repayment. If so, specify the aggregate amount, percentage thereof to the loans granted, aggregate amount of loan granted to promoters, related parties, as defined in Section 276 of Companies Act. Now, friends, here the Schedule 3 says disclosure to be provided in prescribed format where loans or advances in the nature of loans are granted to promoters, directors, KMP, and related parties, either severally or jointly with any other person, that are repayable on demand or without specifying any terms of repayment. So if no period is prescribed or it is payable on demand, then the reporting will be there. So CARO 2020 additionally requires percentage of loan granted. CARO 2020 requires percentage, whereas Schedule 3 does not require percentage. In Schedule 3 to the Companies Act, loans and advances given to promoters, directors, KMP, and other related parties are considered. So if we see promoters, directors, KMP, and related parties, whereas in CARO 2020, loans and advances are given to other than related parties, these are also required to be included. So it says amount of loan granted to promoter related party is defined as this. So here it says loans or advances granted in the nature of loan, either this is this. So it says to any party. It doesn't restrict itself to the promoter or to the related party. However, further reporting is required in CARO 2020. If the loans are granted, then further segregation is required. Then how much percent is given to promoter related party. Here it is restricted only to promoter, KMP, or related party, etc. in Schedule 3. So CARO 2020 is wider in regard to that, and CARO 2020 requires percentage, whereas the Schedule 3 does not require any kind of percentage. So there's a key differentiating factor between CARO 2020 and Schedule 3. Friends, till time we have covered many aspects of CARO 2020, key aspects, audit aspects, the role play or the commonalities or uncommonalities between CARO 2020 and Schedule 3. If you have any questions till time, please note it or please feel free to ask. Or maybe in some time when we are through with our session, at that time I'll give some time to the participants to raise their questions, and I'll try my best to respond to those questions. So if you have any questions, please note it down, please park it down, or maybe you can post it in the chat box and the moderator can take note of it and then it can be discussed.
Absolutely, sir.
Then, if we move on to the next slide, the another point is whether any transactions not recorded in the books of accounts have been surrendered or disclosed as income during the year in tax assessments under the Income Tax Act. If so, whether the previously unrecorded income has been properly recorded in the books of accounts during the year or not. So this clause also we have dealt in detail in our previous slides. Now, if we see what are the commonalities of this clause in Schedule 3. So in Schedule 3, it says details of transactions not recorded in the books of accounts that has been surrendered disclosed as income during the year in tax assessment unless there is immunity, and disclose whether the previously have been properly recorded. So if we see and if we compare reporting requirement of this clause under CARO 2020 and Schedule 3, it's one and the same. There is no differentiation. The only thing in CARO 2020 is that it requires that the unrecorded income has been properly recorded in the books of accounts during the year or not. It requires a reporting on that. So if it is not done, then the adequate reporting will be required to be given in CARO 2020. Otherwise, the appropriate disclosures are required to be given in such scenarios in Schedule 3 financial statement. So there is no differentiating factor in this clause between both the reporting requirements. Then another clause is whether the company is a declared willful defaulter by any bank or financial institution or other lender. There is a reporting requirement in clause 3(9)(b). In Schedule 3, it says disclose following if the company is a declared willful defaulter by any bank, financial institution, or other lender. So if we see the same reporting parameters are getting triggered here by a bank, financial institution, other lender, by a bank, financial institution, or other lender. So it says date of declaration, date of defaults, etc. are required to be reported. So again, if we go through the reporting requirement under both these requirements, there is no uncommonality, there is no differentiating factor for this particular clause under both these scenarios. Now, the third last point with regard to the common points between CARO 2020 and Schedule 3. In CARO 2020, it says whether term loans were applied for the purpose for which the loans were obtained. If not, the amount of loans were diverted and the purpose for which it is used may be reported. So there's a clause in clause 3(9)(c) of CARO 2020. In Schedule 3, it says whether borrowings from banks and financial institutions not used for the specific purpose for which it was taken at the balance sheet date, company to disclose details of where they have been used. So here if we see what is the differentiating factor, CARO 2020 says or speaks about term loans were applied for the purpose. So it only specifically talks about term loans. Whereas Schedule 3 speaks about or requires disclosure about all the borrowings. So it will cover term loans, short-term loans, everything, long-term, short-term, everything. So this is one of the key differentiating factor. Second is it says loans obtained from any of the party. Whereas here the borrowings which have been obtained from banks and financial institutions. So friends, your work paper should be very, very robust. It should plot out the differentiation between both the reporting requirement. You should verify adequately and you should document adequately what you have obtained, and you should make sure that adequate reporting is being done. It should not happen that whatever is reported in Schedule 3, replica or copy paste is reported in CARO 2020 or maybe vice versa, because in some of the clauses what we have seen, there can be differentiating factor. So it has to be carefully evaluated, carefully identified. The thought has to be applied separately from both the perspectives, and then adequate reporting has to be made under both the norms. So if we see what are the differentiating factor here, CARO 2020 prescribes reporting on term loans from any party, like what we have seen here. It says term loans obtained. No specific party like bank, financial institution, etc. It says obtained from any party. So not specified any party means any party. Whereas Schedule 3 says banks and financial institutions, so it does not cover all the borrowing. It says borrowing, but not all the borrowing, not from all the parties. And it says term loan, it says borrowings. Maybe what we have discussed only for borrowings. Then friends, on the basis of financial ratios, aging and expected dates of realization of financial assets and payment of financial liabilities, other information accompanying the financial statements, the auditor's knowledge of the board of directors and management plans, whether the auditor is of the opinion that no material uncertainty exists as on the date of the audit report, that company is capable of meeting its liabilities existing at the date of the balance sheet as and when they fall due within a report period of 1 year from the balance sheet date. So there is a clause under CARO 2020, clause 319. Now, if we see or if we compare this with the reporting requirement in Schedule 3 says certain ratios are required to be disclosed, including current ratio, debt equity ratio, debt service coverage ratio, etc. So those ratios are required to be given. Then explain items included in the numerator and denominator. Then explain any change in the ratio by more than 25% as compared to previous year. So what you have covered in the numerator, what you have covered in the denominator, you have to give the adequate explanation, or you have to give the formula, what components you have used. It should not happen simply a figure is given and then you have given a ratio, or simply a ratio has been given. That is one of the reporting requirement. The ratios are prescribed, those ratios are required to be given. And then you will also have to see that if there are deviations and those deviations are more than 25% as compared to previous year, then those deviations are required to be explained adequately in the financial statement. And on that basis, I mean, those will be key factors for you as an auditor while reporting under this clause in CARO 2020. So here, what we have discussed earlier, when you verify the other information under SH 720, you will also require to take cognizance of information which you have gathered under SH 720. You will also require to take cognizance of the ratios which are disclosed in the financial statement for forming your view and reporting under this clause. So, for example, if the ratios are drastically negative, and if you compare it with your peers in the industry, or if you do a benchmarking and you feel that there are huge deviations in the ratios, those ratios or those deviations may trigger for you to give appropriate or adequate reporting under this clause, which may be negative in certain circumstances. So, friends, you have to take cognizance of all these informations which are in your possession for reporting under this clause in CARO 2020. And in Schedule 3, whatever is required to be disclosed in terms of the specified ratios should be adequately disclosed with the deviations ranging for more than 25%. So if we see the remark column here, CARO 2020 requires the auditor to comment on material uncertainty in payment of liabilities on basis of financial issues and other prescribed matters, what we have discussed. However, Schedule 3 to the Companies Act 2013 requires disclosure of certain ratios. Then, friends, the last point, which is creating the commonality between both the reporting requirements, or which is common between both the reporting guidelines. In CARO 2020, whether in respect of other than ongoing projects, the company has transferred unspent amount to a fund specified in Schedule 7 to the Companies Act 2013 within a period of 6 months of the expiry of the financial year in compliance with second proviso to Section 135 of Companies Act. Whereas Schedule 3 requires details of CSR activities including amount required to be spent, amount of expenditure incurred, shortfall, total of previous year shortfall, reasons for shortfall, nature of CSR activities, details of related party transactions, movement in provisions, etc., etc. I mean, this is a quite comprehensive reporting requirement which is required to be given in the financial statement, which is required to be disclosed in notes to accounts of the financial statement. So, CARO 2020, if we see this, CARO 2020 requires reporting of unspent CSR amount, what we have seen here, unspent. However, disclosure prescribed under Schedule 3 to the Companies Act 2013 are wider as compared to reporting requirement under CARO 2020. So, here unspent amount is required to be disclosed with regard to ongoing projects or with regard to other than ongoing projects. Whereas Schedule 3 requires a lot of information to be given in case of CSR activities like expenditure incurred, shortfall, previous year shortfall, reasons for shortfall, nature of CSR activities, related party transactions, if any. So like many times it happens that in group entities, there are foundations, for example, ABC Foundation or ABC Trust, who carries out the CSR activity on behalf of the entire group. So, for example, there is a company ABC Limited, which has, for example, 30 subsidiaries, 30 components, which are getting consolidated with ABC Limited. And out of those 30 components, for example, 18 components are those components on whom CSR is applicable along with the parent company. So many times there may be a possibility that the company will have its own foundation or its own trust who will carry out the CSR activity on the behalf of the entire group under the brand name of the group. So what it will do, it will collect the amount or the donation from each of the respective corporates to whom the CSR will be applicable within the group. They will contribute it as a donation to that particular foundation, and then that foundation will carry out the CSR activity on behalf of the group. While this activity will be carried out, the foundation is required to give a report or to give a CA certificate to those respective corporates, on the basis of which it can be ensured by the corporates and its auditors that the CSR amount has been utilized for the required purpose as prescribed under the provision of Companies Act 2013. So in those scenarios, when the amounts are contributed by the respective group entities to any foundation or trust which is part of the related party, which is falling under the definition of a related party, the reporting requirement will get triggered here, and the adequate reporting is required to be made in Schedule 3 to the financial statement. So friends, with this, we have covered the interplay of CARO 2020 with Schedule 3. I mean, these are the key pointers, the key common pointers where the reporting requirement gets triggered between CARO 2020 and Schedule 3 both. In some of the cases, there are different reporting requirements. So one has to carefully evaluate, carefully document, and carry out the inquiries and audit procedures appropriately with the respective audit client. Now, coming to the last slide of the day, while we carry out the entire process for reporting in CARO 2020 for a respective entity, we have seen the various scenarios under which CARO 2020 will be applicable, or what are the key audit aspects which are required to be considered. We should also be cognizant of the fact that we have different set of regulators or different set of bodies who are looking to the financial statements or the audit reports. Like there is a separate body called FRRB, Financial Review Reporting Board. There's a separate body called QRB, Quality Review Board. There's a separate regulator called NAFRA, National Financial Reporting Authority. All these regulatory bodies carries out the review of the financial statement which falls under their jurisdiction or their domain. And they have observed the gaps or lapses in the CARO report, in the reporting made by the auditors on CARO 2020 or CARO 2016 in the past. So I'll recommend, I'll suggest, or I'll advise to the participants to go through these reports carefully. So though these reports may be pertaining to CARO 2016, but those clauses, if would not have been eliminated, omitted, or modified, at least those clauses will give you the insights. What were the gaps which were observed by the regulator when they have reviewed the financial statements of the respective entity? So those reports are available in the public domain. You can go into the respective authorities portal. You will fetch the reports. You will find the gaps in CARO 2016 to some extent, CARO 2020 also. And then you can ensure that those kind of gaps are not being repeated or being missed out at your end when you issue your report on CARO 2020 for your respective clientele. So to understand it in crux, what are these gaps? These gaps are in the nature of not reporting on the entire matter stated in the each of the respective clause of CARO 2020. Like friends, as we have seen in one of the clause when I've read it, for example, in case of inventory, the clause is only one, but the clause has 4 or 5 reporting requirement. So like for example, inventory has been physically verified, or the variation is of more than 10% or not, etc., etc., each class of inventory, etc., etc. So when you report on a particular clause, you have to evaluate each of the reporting requirements separately, and you have to see that the entire matter of the respective clause has been reported. This is one of the key aspects which you have to consider, because it has been observed many a times auditor just report on the first reporting requirement of that particular clause, and they just miss out to report on the other clauses of that particular clause, other reporting requirement of that particular clause. It may be a possibility that other reporting requirements do not get triggered, but still you will have to report that they are not getting triggered, and that's why there is no reporting. But then you have to be very adequately and explicitly clear for those particular clauses. Second, inadequate reporting. The reporting is not clear. The reporting has been made on all the particular requirements of the particular clause, but it is not clear. It is not giving the exact meaning, what is being sought upon by the regulator and what has been reported by the auditor in its audit report. Reporting in CARO 2020 does not matches with the reporting made in Schedule 3 FS, like what we have seen just now. If we compare the common clauses between CARO 2020 and Schedule 3, there may be a possibility where the clauses are common. However, the reporting has been done in a different manner or of different parameters in CARO 2020 and Schedule 3, though there is no differentiating factor between CARO 2020 and Schedule 3 with regard to those clauses. So this is something which is again required to be carefully observed and evaluated by the auditor while issuing their audit report on CARO 2020 and the financial statement. Incorrect reporting. The reporting is altogether incorrect. The company has stock in trade, for example. However, the auditor says there is no inventory, which is incorrect reporting. So these are the gaps which have been observed by the regulator when they have reviewed the financial statements. These are the broad indicators of the gaps. It will be more beneficial that you will or you go through the reports of those regulators which are available in the public domain, and those reports will be very much helpful and beneficial for you when you will be concluding on the CARO 2020 report on this financial year for sign-off purpose. So friends, with this, we are through with our today's presentation on key aspects of CARO 2020 and interplay of it with Schedule 3. Thank you very much, friends, for patience hearing, for patience listening. Happy to answer any questions if anyone has. Yes, Srishti, please, if anyone has any questions, I'll be trying my best to respond to those questions.
Okay, sir. Sir, I've picked up a few questions from the participants. One of it is wants to ask you that will the management representation letter regarding the adequacy of inventory verification suffice the CARO reporting by auditor?
Sorry?
The management representation letter regarding the adequacy of inventory verification suffice for the CARO reporting by the auditor?
No, management representation will not suffice the reporting requirement. I mean, as an auditor, you will have to carry out your processes separately. I mean, management representation is an additional document for you, but you cannot solely rely on the management representation. You will have to look into the documents, the inventory verifications, which have been carried out by the management. So that
Okay.
cannot be the only document for concluding reporting on this parameter.
Okay, sir. So next question is that is there a change in the form of audit report under CARO for the financial year 24-25?
No, there is no change.
Okay. So the same form is being followed for this year as well?
Yes, yes. There is no change in CARO 2020. The same form is there. And there is no change in the guidance note also in CARO 2020. Issued for CARO 2020 is the same which was issued earlier. However, as I explained earlier, there are two guidance notes on CARO 2020. So the participants should take note of it. The latest one, which was issued by ICAI, which is guidance note on CARO 2020, revised 2022, that should be used by them.
Sure. Sir, another question. It says that the private limited company exceeds the limit of its turnover of rupees 10 crore and paid up capital and reserves exceeds rupees 2 crore. But it is a small company, whether CARO 2020 will be applicable on it or not.
No, if it's a small company, then there is a specific exemption. If it's a small company, then this will not get applicable. So even though it's a
Okay.
private company, and if the criteria are triggered, but then it has to be carefully evaluated if the criteria are triggered and still it is a small company, whether that fact is correct or not. But for example, if the fact is correct, if it is still a small company, then there is a specific exemption to the small companies.
Okay. So another question, it says that there are some parts in the Act which still have some uncommonalities between the CARO and the Schedule 3. Are these being kept intentionally, or these are just still pending matters which are need to be harmonized or sorted?
No, I mean, these are two separate reporting requirements. So Schedule 3 requires reporting from the company side, from the management side in their financial statement. So which is available to a reader of the financial statement that, okay, these are the disclosures which are being made. And those disclosures are quite elaborative and exhaustive. Whereas CARO 2020 requires reporting. So the reporting, and if the reporting is negative, then it further requires elaboration. So there can be a possibility, and the fact is still there, that there is a uncommonality between both the reporting requirement. So it can't be said that it is intentional also, but the regulator requires a certain set of information to be getting captured into a certain set of document. So whether it is a financial statement or audit report, they want a certain set of information to be captured only to a limited extent in a particular document. So that's how it has been kept as of now.
Okay. Okay. So the last question, it says that 100% subsidiary private limited company is incorporated in India, and it's a subsidiary of a foreign company. Whether a small company exemption would be applicable to it or not?
So here again, the definition of small company will have to be evaluated. If the definition of small company is getting fulfilled, then yes, the exemption will be available. But if the small company definition is not available, getting triggered, then the benefit will not be available. So I'm not touching upon the definition right
Okay.
now on the small company. That is very well prescribed under the law and even in the guidance note of CARO 2020. However, if that parameter is mapped and it is matched, then the exemption will be available.
Okay. Absolutely, sir. So that's it in terms of the questions. I would like to end this by thanking you for taking out your valuable time and sharing your valuable insights on this very, very important topic of auditing aspects in CARO 2020 and its interplay with the Schedule 3. Your expertise has really provided us a deeper understanding of the subject. And I'll also like to thank our audience for their active participation and their thoughtful questions.
Thank you, madam. Thank you so much, sir, for such a wonderful deliberation. You have covered mostly all the aspects relating to the CARO 2020 and covering with the correlating with the Schedule 3. So you have shared the in-depth knowledge with our knowledge. So thank you so much on behalf of AASP of ICI. I also thanks towards madam to kindly coordinate the wonderfully coordinating this today's webinar. So thank you so much, ma'am, for coordinating the webinar. And on behalf of AASP, once again, thanks towards CMA Thondia ji for gracing this webinar as well as sharing his in-depth knowledge with our members. Thank you so much, sir. Thank you so much, ma'am. Thank you.
Thank you,
Thank you,
sir.
Anil ji.
Thank you so much.
Thank you, ma'am. Thank you, sir.
Thank you,
Thank
the
you.
entire ASB board for giving me this opportunity for sharing the limited knowledge I have.
Thank you,
very
sir. Thank you. Good evening. Good evening.
Thank you. Good evening.
Thank you.